BigBear.ai Holdings Inc. closed its last trading session on Friday, May 22, 2026 at 4 p.m. EST at exactly $4.18 per share, marking a minor intraday decline of 0.48% on a heavy trading volume of 65.60 million shares, which significantly outpaced its recent average daily volume. If you look at the after-hours market activity, the stock continued to tick down slightly by an additional 0.21%, settling around $4.17. The equity market is closed today, Monday, May 25, 2026, in observance of Memorial Day, meaning these figures represent the absolute latest pricing foundation before trading resumes tomorrow morning. Most retail traders watching this stock right now are looking at the wrong numbers, completely missing the structural shift happening behind the scenes. While standard online investing message boards focus entirely on the net loss or historical software volatility, institutional players are quietly accumulating shares due to a quiet balance sheet restructuring and a massive backlog expansion that just crossed a vital threshold. The typical trader looks at a headline net loss and immediately exits their position via their individual brokerage app, while sophisticated desks running algorithmic self-investing setups look at contract longevity and defense agency stickiness. That gap between superficial panic and structural evaluation is exactly where retail accounts lose their positioning to institutional wealth managers. The common consensus surrounding this enterprise is that it is simply another speculative, low-margin federal contractor struggling to stay relevant in a crowded landscape dominated by massive defense players. People open up popular investing sites or check their favorite Robinhood stock trading dashboard and assume that because the share price has experienced massive multi-dollar swings, the business model itself is fundamentally broken. The expectation is that small-cap defense data players cannot scale effectively without massive dilutive capital raises. The reality, however, is that recent defense allocations have given this specific organization an incredibly deep operational mode in high-consequence national security decision intelligence, establishing a long-term revenue backlog that guarantees institutional engagement for several fiscal periods. When retail investors think about making an asset allocation on popular trading options, they usually drift toward big names like Tesla stock, Apple stock, or Nvidia stock, because those companies offer immediate visibility and high liquidity. But true wealth generation often requires looking at the unglamorous layers of data infrastructure supporting federal logistics, automated threat detection, and border surveillance systems. While standard software tools are designed for mass commercial adoption, this business builds specialized software that operates at the tactical edge where civilian applications fail. If you look closely at recent performance, the stock movement has been dictated by macro positioning rather than micro execution, creating an environment where a single large federal procurement notice can cause massive short-term valuation adjustments. If you look at the recent trading metrics from the mid-May session, the daily trading volume spike to over 65 million shares indicates that heavy programmatic accumulation or distribution is taking place among large market participants. When you analyze institutional activity through specialized platforms like the Interactive Brokers platform, you see that block trades have risen considerably over the past 2 quarters. This implies that while retail investors might be executing fractional trades on a standard retail mobile setup, massive hedge funds are utilizing institutional liquidity to lock in large blocks of shares while the valuation remains under a key threshold. Sector momentum has been highly fragmented, but defensive technology assets are receiving a structural tailwind as global supply chains and border security environments face heightened volatility. Understanding how to navigate these microcap fluctuations requires a solid grasp of how modern online investment platforms handle execution and asset management. Many retail traders use basic automation tools like Schwab Intelligent Portfolios or various entry-level investing sites to manage their general market exposure. But tracking a volatile small-cap defense stock requires advanced data feeds. For example, traders tracking real-time order flow through the Interactive Brokers platform or using advanced indicators on the Fidelity trading platform can see that deep institutional support levels have formed just above the multi-month lows. This implies that major entities are willing to absorb selling pressure, viewing the current valuation as a highly asymmetric risk-to-reward setup, despite the broader tech sector cooling off. Let us look deeper into how these different brokerage ecosystems cater to individual portfolios during periods of high market stress. If you manage an individual brokerage account through Fidelity Investments, your perspective might lean toward long-term fundamental metrics, analyzing how Fidelity mutual funds or specific thematic Fidelity ETFs are structuring their small-cap technology holdings. On the flip side, someone executing daily trades on the Robinhood app or using SoFi Active Investing might be focused entirely on short-term technical resistance levels and social media sentiment. This divergence in investor behavior creates intense volatility, as short-term traders dump shares at the first sign of an earnings miss, while long-term institutional portfolios continue to hold their positions through the chaos. To really understand what is happening here, we need to examine the financial structure that underpins this whole narrative.
In its recent first quarter financial report for fiscal 26, the company posted a revenue beat of $344.44 million against Wall Street consensus estimates of $336.6 million, indicating that core operational execution is tracking ahead of expectation. However, net margins remain pressured due to high integration costs related to their recent corporate acquisitions and extensive engineering talent retention expenses. This mismatch between growing top-line contract wins and persistent bottom-line net losses is exactly why the stock remains a battleground for aggressive short sellers and highly speculative long-term growth investors alike. Comment below how many shares of BigBear.ai you currently hold in your individual brokerage account right now, and let me know if you are buying this dip or waiting for a clearer trend. The structural foundation of this business relies heavily on specialized data fusion, predictive analytics, and machine learning architectures custom-built for high-security environments. Rather than attempting to compete with hyperscalers or build massive general-purpose models, their operational framework is designed to clean, structure, and automate complex data workflows across multi-layered legacy federal networks. A key example is their extensive multi-year engagement with the United States Army to modernize legacy frameworks into a singular enterprise intelligent automation infrastructure. By managing high-priority logistics data for senior combatant commanders, they have secured a highly recurring service revenue stream that is virtually immune to typical enterprise software budget cuts or commercial market downturns. When evaluating an allocation to this space, self-investing individuals need to think critically about how they construct their overall technology exposure. For instance, holding high beta small caps alongside highly liquid assets like Apple stock or Nvidia stock can provide massive upside potential without exposing an entire retirement portfolio to extreme drawdowns. Many younger investors utilizing SoFi investing or various automated tools like a SoFi robo-advisor overlook the importance of balancing speculative growth with core blue-chip infrastructure. If your entire portfolio is weighted heavily towards speculative tech without matching it against cash positions or high dividend vehicles, a prolonged period of high interest rates can severely damage your compounding capability over a multi-year horizon. The core business model of this firm thrives on converting large-scale, unstructured data into highly actionable, real-time tactical insights for homeland security, international trade routes, and military resource planning. Their strategic footprint expanded significantly following the integration of specialized digital identity and biometric verification systems, allowing them to secure crucial border management and customs logistics partnerships globally. This means their software is embedded directly into critical infrastructure networks, making it incredibly difficult for a client to swap them out for a competitor due to the immense security clearance requirements and structural implementation costs involved. This structural stickiness is something that traditional financial screens fail to capture when evaluating simple price-to-earnings or price-to-sales ratios. If you analyze how modern platforms like Robinhood Investments or SoFi Invest present these metrics, they often highlight standard financial health scores that can paint a misleading picture for a growing technology contractor. A high net loss look on a basic Robinhood cash management interface might frighten a casual investor, but it fails to show the massive multi-million-dollar defense backlog that represents contracted future revenue. This is why investors who rely entirely on basic retail investing sites often underperform those who use advanced investigative tools to read through regulatory filings, contract announcements, and federal procurement databases to understand where the capital is actually flowing. Looking ahead, the future outlook for this asset rests on a razor-thin balance between two distinct macroeconomic scenarios. In the bullish scenario, accelerating global security demands and automated customs modernization efforts will drive accelerated adoption of their edge computing software, pulling the company into consistent profitability by the end of the next fiscal year. This would likely trigger massive institutional inflows from Fidelity wealth management desks and various small-cap indexes, driving a rapid reassessment of their valuation multiple. In the bearish scenario, prolonged federal budgetary delays or execution roadblocks on major system integrations could stall revenue growth, forcing further dilutive capital measures that would harm existing retail shareholders. When you look at your investment strategy through the lens of expectation versus reality, the contrast becomes incredibly vivid. The market expects this company to remain a highly volatile, cash-burning entity that cannot compete against top-tier global consulting firms or massive aerospace defense conglomerates. The reality is that by targeting specialized niches like secure biometric customs logistics, tactical battlefield data orchestration, and automated force management, they are building a highly defensible software ecosystem that cannot be easily replicated. This operational distinctiveness gives them a unique position in the small-cap landscape, providing an option for aggressive traders who want pure-play national security software exposure without paying the massive premiums demanded by major enterprise tech giants. Ultimately, navigating an environment like this requires choosing a trading infrastructure that aligns with your execution needs and risk tolerance. Whether you utilize advanced routing options through interactive brokers trading, manage long-term retirement assets via Fidelity IRAs, or maintain a highly liquid trading balance on the Robinhood app with Robinhood fractional shares, understanding transaction friction and execution speed is vital. High-volume, volatile stocks can experience massive slippage during sharp market reversals, making it imperative that individual brokerage users leverage limit orders and structural stop losses to protect capital. Managing your risk carefully while maintaining objective clarity on fundamental data is the only consistent way to outpace the broader indexes over the long term. To tie everything together, the true narrative surrounding this equity is not found in daily price fluctuations or short-term options flow speculation, but in the long-term execution of its federal software pipeline. The market's expectation of persistent structural weakness is constantly being challenged by the reality of increasing backlog volume, growing edge computing integration, and expanding international border security deployments. As these contracts mature and scale into high-margin software maintenance cycles, the financial profile of the business has the potential to shift dramatically, forcing an aggressive reevaluation by mainstream Wall Street analysts. Keeping a balanced view, protecting your capital against extreme small-cap drawdowns, and monitoring institutional order flow will remain your best path forward as this technology landscape continues to mature. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.